Hello guys and welcome to another deep video. Today taking an in-depth look at Carnival Corporation. Carnival Corporation is a British and American cruise operator with a combined fleet of over 90 vessels across 9 cruise line brands and one joint venture with China State Shipbuilding Corporation. As of the 20th of December, their stock price is $25.1 with a market cap of 32.3 billion. Their median 10-year P is 18.2 and their trailing 12 months P is 21. So they're trading above the historical average. Their price to cash flow is 5.5 and their dividend yield is 0. Their revenue has grown by 3.7% over the past 5 years, but as we can see, they had a huge dip in 2020 and 2021 because of the pandemic. They've managed to recover. Their net income has decreased by 102.8%, but as you can see the trend, they're improving from their pandemic lows and managing to get back to profitability. Their earnings per share is the same, minus 101%. Their common shares outstanding have increased by 97.1%, which is horrible in my opinion. This is just too much dilution, but it's not like they had the choice. Their balance sheet now, let's take a look at the solvency ratios. The interest coverage ratio is 1.86, which is pretty bad. The quick ratio is 0.26, which is also pretty bad. The long-term debt equity ratio is 3.1, and the debt equity ratio is 3.36. Both are very, very high. Their cash from operations has decreased by 21.8%. Their cash from investing has decreased by 46.8%. Their cash from financing has increased per se by 676.9%, and their capex has decreased by 39.5%. Most important of all, their free cash flow has gone from negative 1.3 billion to positive 1 billion. So that's pretty good change over the past 5 years. Their financial ratios look much better than their balance sheet. The return on equity is 22%, the return on investments is 9.5%, the return on assets is 2.5%, and the return on invested capital is 8%. Now let's find the fair value. Doing a DCF valuation with a 5% revenue growth rate over 10 years gives us a 17.4 dollars fair value using three multiples: earnings multiple, operating cash flow, and free cash flow multiple. We get a fair value of $44, and the average analyst expectations is $27.5. Giving using the average of all three, we get an intrinsic value of $29.7. Applying a 15% margin of safety, we get an unsettled buy price of $25.25, making the stock a buy uh, using this margin of safety, of course. Now, as for my conclusion, I believe that this is not actually a buy, this is a value trap. And why? Well, you might ask that. Well, their balance sheet, first of all, is horrendous. Even if they, hypothetically speaking, get to a 6 or 7 interest coverage ratio, which they want, at least in this decade, I don't think they want. Even if they do, they're still a mediocre company. There are much better companies out there right now. Not many, but there's still much more companies out there that are trading at a similar discount to fair value and that have much better fundamentals. The stock market is not a question of is this necessarily a buy, because a lot of stocks are a buy, but the thing is, which is more of a buy? You should, as Dave Kantasari, I think is how it's pronounced, said the best. You shouldn't have 20 best picks. You should have 10, 11, maybe 12 stocks. This should be your best picks, your best targets. And I believe that Carnival, even though they're trading at a discount to fair value, they're not a buy because there are much better opportunities out there at the moment. Of course, you should search for those, and you should also do your own due diligence because maybe my projections are not accurate, my multiples are not accurate. You should do your own research first. This is applies to all investments, to be honest. Carnival is not a buy because of their balance sheet, first of all, and second of all, what I don't like really about these types of businesses like Carnival is that they have huge capexes. Now, why is that a problem? Well, as as Warren Buffett put, there is a great book, Money, the Money Masters of Our Time. And in there, Warren Buffett, when asked about different industries, said something very interesting about companies in um, heavy industries, like, for example, automotives. And he said something like this: the stockholders pay for a company's stock so that the company can return a few percentages in free cash flow. And then when crisis hits, they have to borrow so much more money that for the next 10 years, the stockholders get basically 1 to 2% per year. Because this is what happened with Carnival. You get nothing, literally, you get no return. The the only way this is a play is not because they're a great company. This is just because they're undervalued. For example, let's look at something which grows. If you buy Amazon, sure, Amazon is overvalued, but they're a genuine company with a great balance sheet, and they have wonderful businesses. This is not a wonderful business. This is just a bad business that's been absolutely destroyed by COVID, and you can get some value because even in the trash can you can still find value. Even when you recycle something, there's still value. So I think that's how I can compare Carnival Corp. This is mostly a cigar butt play if it manages to reach 15 to $18 levels. This is not a long-term play at all. Never will be, to be honest. Not the right industry. Now, of course, leave your own opinions in the comments. Maybe I'm not hitting the right points, but as always, do your own due diligence. Today we have an affiliate, Ticker Data. Ticker data is one of the best tools out there if you want to make, for example, if you want to make a spreadsheet with your portfolio, if you want to get real-time financial data, if you want to make a DCF and somehow you need real-time financial data, if you want to do a lot of things in spreadsheets and you need financial data, Ticker data is the best place to find it. Ticket also has some great Excel templates, so you can make you can get a template for your portfolio, for valuations, for bank valuations, for a lot of things. It's just the greatest value out there in the market for such a thing, for such a tool. It's a great tool. I personally use it for my portfolio tracker, and you should too. You can find the link in the description below. Now, another great thing, of course, is my blog where I feature in-depth analysis. You can check it out in the description below. And yeah, because we've wrapped this up, I think I'll see you in the next video. I hope you comment on this one so you can leave out your opinion. And yeah, bye.